Chicago Fed President Goolsbee on Squawk Box this morning defending the validity of BLS data and the shortcomings of relying just on private sector sources. Joining us here at Post 9 this morning to talk more about it, Goldman Sachs chief economist Jan Hatzius, who normally joins us on Jobs Friday. A little bit different today.
It's a Jobs Friday, except there are no jobs.
Yes. Do you feel like you're flying blind or no? He seems to think that BLS is still the gold standard.
Oh, for sure. It's a significant handicap. There's definitely less information. And yes, we can use ADP, we can use Homebase, we can use surveys like the ISM and things like that. But it's not the same as having the government data.
Are you thinking about whether or not the shutdown lasts into the reference week?
It certainly could. I mean, these things are always a little bit hard to predict how long they last, but at the moment, it certainly seems like we're not that close to the end yet. So it may spill into the next month. That's a possibility. We do look, obviously, at the private sector sources and anything else we can get our hands on, and the state unemployment claims that he referred to. But I don't think we have that much information. What we do know is that job growth has decelerated very, very significantly. A significant part of that is reduced immigration, reduced labor force growth. But the labor market is also loosened. And you can see that in the unemployment rate to some degree. But you can see it more, I think, in other indicators, such as the job availability index, jobs plentiful, hard to get, that the Conference Board puts together, and some of the other surveys, ADP obviously also.
As we think about what this means for the Fed's rate path, and as everybody is searching for alternative data to supplant the government data, with the Fed's dual mandate of jobs and inflation, is the alternative data better for one versus the other? Will we get a clearer picture, for example, of jobs data from the alternative data versus inflation data, and might that skew some decision making?
Look, I think it's relatively symmetric that we have a decent amount of information about high-frequency price moves and changes in the jobs picture, but not a good picture. So I do think what it probably does do is freeze you in place. I think it has sort of cemented the idea that they have signaled probably will get an October cut. And that is, I think, very likely to happen. And we've been expecting 3 cuts this year, so we're looking for another one in December, although that is more subject, obviously, to what else we learn.
This also comes at a time, Jan, when it feels as if investors have gained some comfort that the softening up of the labor data is not necessarily fully representative of the path of GDP, at least in the short term. We've seen this divergence. Can you be confident in that? What do you think the underlying trajectory is for the economy?
Well, for sure, the GDP data has been better. Yeah. We've been upgraded. We've seen upward revisions to Q2. We've upgraded Q3 to nearly 3%. There are some estimates that are even higher than that. Now, GDP is complicated this year because of some of the front-loading distortions around tariffs, around imports. So I do think that the economy is growing at a below-trend pace, and on a Q4 to Q4 basis, we're still clearly below 2%, maybe 1.5% or so. And the labor data, I think, or reinforces the idea that the economy is going through a weaker period. I am always paying attention to labor market numbers that consistently surprise on the downside and are consistently revised down. So I certainly don't want to sound the all clear. With that said, I think there are reasons to believe that 2026 is going to be a little bit firmer. We are getting some tax cuts. We're getting Fed easing, and the tariffs are going to be more in the rearview mirror in terms of the impact on growth.
I think your forecast on payrolls is pretty consistently better into the second half of next year, right?
Yes, we do expect a pickup. I mean, we've been running at about 30K a month over the last three months, and we think we'll pick up to something above the break-even rate, which I think is probably going to be 50-ish or so in 2026. And under our baseline forecast, the unemployment rate goes to 4.5% and then gradually comes back down. But I emphasize that's the baseline forecast. And while you're going through this clearly weaker period, you've got to be alert to signs that the baseline forecast is too optimistic.
Greg Ip with a nice piece in the Journal today looking at, to Mike's point, the split between GDP and employment and whether AI is really having an impact on jobs. Do you have a clear view on that yet?
I certainly think that technology is having an impact. We recently looked at the productivity average in this expansion. If you started, you have to start it from late 2019 because the numbers go haywire during the pandemic. But we've been seeing productivity growth of about 2% versus about 1.5% in the previous cycle. And that outperformance is concentrated in technology-heavy parts of the economy. That said, I don't think it's really AI. AI is, maybe is having a small impact there, but most of the AI boost has yet to come.